Hello there, property enthusiasts. Welcome to another insightful episode of Leverage Addicts, where we bring you the latest trends, expert opinions, and real-world insights from the world of property investing. I'm your host, Blandon, and today we brought back one of the special guests who's no stranger to the property development game. Please join me in welcoming Marc Abbott.
Thank you very much for having me.
Yeah, and if you guys don't know already, he's a seasoned property development consultant from Ashcroft Homes. So I just want to welcome you today, Marc, and we're excited to dive into some pressing questions about the property market at the moment. Obviously, the recent election, sort of what lies ahead for property developers. And for some of our first-time listeners as well, maybe you can give us a quick intro to what you do.
Yeah, for sure. So I'm Marc, and I'm a property development consultant at Ashcroft Homes. Ashcroft Homes is basically a standard plan building company here in Auckland, and my role with them is to assist potential clients right from initial concepts right through to build contracts and actually building houses. We build for mum and dads, investors, and developers, and we basically offer a nice, neat, simple package, an easy way for people who aren't experienced in developing property to either do a large-scale development or simply build in the back, utilize that potential that's just in there.
Yeah. And if you guys haven't heard the first episode already, I learned so much about development from Marc, because when I sort of first explored that area, he taught me pretty much everything, like the stormwater, wastewater, building coverage, what you could fit on the site, and I asked him like some strange question. He would always get back to me. So you're the man, Marc.
Thank you. There's a lot to learn.
So what are your thoughts on leading up to the election, the potential results coming?
Yeah, so obviously elections are always an interesting period in time, right? There's typically, we'll see 6 months before, 6 months after an election. People sitting on their hands, it creates uncertainty. People aren't sure, especially this election, people really weren't sure what the outcome would be. And at this stage, obviously, time of filming this, we're not 100% sure of the outcome yet. Anyways, we're still waiting for all the special votes to come in. However, it does look like we're going to have a change in government. And if it is a national-led government that takes New Zealand forwards, we do expect to see some changes in both policy and perhaps the outlook of investors and developers in the market.
Yeah, I was catching up with David yesterday, and he was talking about how potentially if New Zealand First don't play ball, we might not be able to pass some of these bills through. So let's see what happens.
Yeah, it'll certainly be interesting. If National and ACT can form a government alone, that will be very different to New Zealand First being involved.
And what's the general feeling within development market, in the last 12 months that you have seen in your space?
Yeah, I think it's been a really interesting period. We've obviously seen a slight reduction in actual house prices, which is obviously very important to anyone who's developing to sell. At the same time, we've seen a pretty big jump in interest rates, which obviously affects anyone who's looking to develop if you don't have a lot of cash. And I think that sort of created this environment that has challenged a lot of developers and also people who are basically just looking to sometimes build an extra house in the back. So we've seen less development. We've probably seen a change in the type of projects. So even some of our experienced developers are no longer looking at removing that existing house and building 8 terraced houses. Often now they're asking us the question, well, what can we just fit in the backyard? Can we reno that existing house, get that on the market or rent it throughout the build? What can we actually fit in the back? So there's been a definite change in the type of development, but also the fundamentals are changing for a lot of people. A lot of people are looking at building to rent now, and perhaps that's the effect of some of the policy we have seen over the last 6 years, where people are wanting to hold the properties past the bright line. So a lot of my clients have actually built to rent in the last 12 to 18 months, and when I say a lot, probably 80 to 90%. So I've seen a noticeable shift.
Out of how many though?
Any one client can build a number of houses. I'm seeing clients who are doing developments of the scale you'd expect a developer to be doing. So say 5 to 8 units, but they're doing that build to hold. A definite shift in people's mindset.
What would you say the difference in numbers look like for something like a property? It's got an existing dwelling and you would maybe chuck 2 at the back, versus if you got rid of the existing house and then put 8 on? What difference are there? Is it the margin? What are the differences?
Right now in this market, there's a couple of differences. The first one being finance. So really hard right now to get the $3 or $3.5 or $4 million it takes to do an 8-lot development. We're seeing people in very good financial positions struggle to do that. Even the people who can do that, when you're borrowing at say 10 to 15%, it can really affect the numbers on a development. It's not like it was 2 or 3 years ago when people were borrowing at say 4 to 8%. Yeah, I'll have to cut there. Go remind me a question.
So what would be the difference between building 8 lots versus just keeping the existing and build a couple?
Yeah. So obviously finance, number one. The next thing, I guess, funding.
It's okay, man. Don't
length
worry.
Of time. Yeah, what else would be?
I think funding is huge.
It's probably funding.
Typically, I would say maybe you can bounce on me saying you do the numbers. What do you see on your side? You can just pass it back to me if you want.
Yeah, interesting. I'd say first and foremost is funding. So the difference between funding a $3 or $4 million development compared to funding, say, a $1.5 million development is huge. And perhaps, you could use some of your experience to let people know just how hard it is right now.
Yeah, no, definitely. You're right in saying that. So the biggest difference is probably the funding side of things. Obviously, borrowing $1 million is way easier than borrow $3 million. Although, from what we can see on our side, the margins would stack up to be better in the 8-lot development. Obviously, a bigger project means that you can sell for more, you make more money, but it does seem like maybe that's a safer option going for the 2.
Yeah, definitely. And I guess the existing house is worth talking about. So you keep that existing house so long as we don't have to move it on site. You find it nowadays it probably costs $450,000 to go build a nice 4-bedroom house. If you can sink $100,000 into that house and do a really nice reno, you've got the ability to rent it out through the build or sell it to basically help fund the project. So you're sort of creating a bit of certainty at the same time as I guess removing some of the risk with a bigger project, because basically bigger project, the first thing we do is knock down the house. So the banks also tend to like that sort of setup in terms of funding, keeping the existing house, especially if you're able to rent it throughout the build, because it really helps with the servicing.
Yeah, you've got some income coming in while you're building, whereas if you remove the existing house, obviously is a piece of land. Right. No income.
And no security from a bank's point of view.
That's right. So no, that's really good. So I think a lot of it maybe is just a comes down to relooking at the risk and the return.
And I guess there's one fundamental. I've had this conversation many times with clients, but the only number that's really important when you're developing is really the difference between how much you spend and how much you make. So if you spend $4 million to make, say, $1 million, it's still relative if you spend $1.5 million to make, $400,000 or $500,000. It's all relative, but often people think the bigger they go, the more money they'll make, and it's not always the case. And it's kind of the same thinking between everyone always wanting to go 3 stories, and sometimes actually it's more cost effective just to build 2 stories.
That's exactly why I made the decision to just build a single-story 4-bedroom in my South Auckland property. But that's really good. So how will the election results, you think, will sort of change the development market?
Yeah, I think it's going to have a big impact if we do see a national-led government. Number one, what it does create is a lot of certainty for people. So people will now be able to move forward sort of knowing what the next 3 years are going to look like at least. In terms of the actual policy, so National's actually got a really interesting document out called Going for Housing Growth. Really worth a good read if anyone is in the space, wants to get a better understanding of perhaps where we'll see things going. But basically, at the outlook, National appear to be a little bit more landlord-friendly. So they're likely going to reverse some policy or change some policy. Typically, national governments have been more landlord-friendly. We're hoping that they're going to be a bit more developer-friendly. They've made talks about, for instance, reforming the RMA, make it easier to get consents, cheaper to get consents.
They always say that.
Yeah. Well, and every government does. I just want it to be faster to get consents, to be honest. So I think all of that sort of stuff has a big impact on what we do. But specifically in terms of policy, interest deductibility, if they remove that, that's obviously great for landlords. And we just talked about, how a number of clients, I've got a building to rent. So people are doing that to sometimes avoid the interest deduct, because obviously new builds can claim your interest as a deductible. But rolling that back again, it's just going to increase the viability of owning rental properties. And that is really good for the housing market and the development market. We've got clients who want to build to rent. This sort of policy will really help them do that.
It's interesting that you said that, because if I look at some of my bigger clients who have a property portfolio and they're building property, properties, right? Under the Labour rule, they want to encourage more new builds to go to first home buyers. But what this interest deductibility rule have forced these bigger portfolio people who are developing to hold all of the new builds and sell all of their old stuff. So they're putting more old properties on the market. Yeah, that's interesting consequence of what they were trying to do, forcing developers or property investors to go another way.
And I think it's been a real tough time for a number of people, especially your mum and dads who perhaps just have one rental property they've worked really hard to acquire, and then they've seen a lot of policy change over the last 6 years, and that's definitely impacted a lot of people.
How do you think that's going to affect the new build prices with some of these changes?
I think it will be interesting. At any rate, there's a lot of factors that are going to impact the new build pricing. Personally, I think migration is probably one of the biggest factors. I mean, we've seen a huge amount of people move into New Zealand in the last 6 to 12 months. Traditionally 2/3 of those people are going to settle in Auckland. We simply aren't building enough houses. So policy will affect where we see house prices go, but I also think supply and demand is going to be huge in the next 2 years. If I look at the construction industry as a whole in the last 2 years, we're still building projects that were consented 2 years ago. A lot of those were being sold off the plan en masse and all that sort of stuff. A lot of that has stopped. So I wouldn't be surprised if there's a lag in new builds, hitting the market in the next sort of 12 to 18 or 24 months. Another interesting thing is Kia Ora has been very active in terms of developing their own portfolio. So that's been interesting to see them actually, start undertaking developments at quite a large scale.
They stopped buying in the last
which
18 months.
I think is good. It absolutely makes sense for them to have that model for social housing in New Zealand, because they actually own a lot of land, and a lot of it's just got one house on it. And developing their own land is a lot more cost effective for our country than going out and buying $1 million new builds that a private developer has developed.
So what I'm hearing from what you said is potentially because the pipeline has stopped, because all the developments like, okay, we're going to finish this lot and not going to build anything. So less new builds are going to come on. That potentially could dampen the supply, therefore driving up the prices. I think the interest deductibility might take off some of the demand for new builds, because if existing builds get the same thing. But land prices certainly have to come down.
In all scenarios, yeah. Land is certainly too expensive and has been over the past. Part of what National does cover in this document is how it plans to unlock some development land. And essentially they're wanting, my understanding is basically they're wanting councils to identify 30 years worth of developable land within their regions, and then they're wanting them to make it able to be developed a lot sooner than 30 years' time. In here it does talk about some stuff like current future urban land, which basically you can't really do much with now apart from sort of a zone change. They're talking about stuff like that perhaps becoming or being upzoned immediately, I think, or relatively quickly. So I think it'll be interesting to see how much of this National can roll out. But if we can make land cheaper, end values or houses will become more affordable for first home buyers, which I think is very important. The other thing we really need to look at is build prices. We seem to have very expensive cost to build in New Zealand. A lot of it tends to be more material related than tradesperson related. Our tradesmen are very well priced compared to countries like Australia, who have some very, very highly paid tradesmen people. In this document, National does also talk about Building Act reform and trying to make the material supply market more competitive in New Zealand, which I think if you can do those things is free up some land and then make building cheaper, that will definitely lead to more affordable housing in New Zealand.
Yeah, I still think the challenge with MDRS is, like they said, infrastructure. Yeah. Even if you have more land, it's like, well, how do we get all the supply for stormwater, wastewater, electricity, gas? We have to spend a lot more in infrastructure before that the land becomes useful. But yeah, it'll be interesting to see, how much they can execute.
There's other things like, they've indicated they want to reduce the bright line to 2 years. Again, that will incentivize private developers quite a bit. With a 10-year bright line, you've either got to hold your properties for 10 years or sell at the onset. This might encourage some people to build and perhaps have a shorter term hold to avoid paying tax.
No, that's really good. So obviously it has been a challenging market. How have your clients or Ashcroft Home clients sort of dealt with it in the last 18 months? What have you guys sort of helped your clients do to get through this period?
Yeah, so a lot of back to basics. So and it starts right at the outset where, people phone us and they're inquiring about that big development, or, and they're saying, well, how can I maximize my land? Having that conversation again and saying, well, actually, what can you afford to do? So we're looking at finance a lot earlier in the piece with a lot of clients, because people can start spending, pretty considerable money pretty quickly without knowing that they can necessarily actually afford to do that. So that's where we're bringing brokers such as yourself into the equation and really working a lot closer with clients to see what they can actually afford a little bit earlier in the piece. Build in the back, we touched on that before. It's sort of perhaps a more enticing way to develop in this current market. It really creates a bit of certainty and reduces the risk. I think people don't want to commit to huge building projects right now if they're heavily financed, and sometimes at some pretty crazy interest rates. Some of that would have been the election as well, but definitely a change in mindset in terms of the type of projects our clients are looking to do. Another really important thing is basically just getting ready to pull trigger on actually building. So people don't realize how much time you can spend on your concepts and then your consent to actually pull trigger and sign a contract. The way Ashcroft's process works, so we'll do concept plans for people, then go ahead, do the resource consent before you actually sign a contract to build with us. Some clients might only spend $60,000 to arguably get halfway through the build process, so they haven't actually built anything yet, but they've got the resource consent ready to go. So that's a really powerful place to be. Once you've got your resource consent ready to go, it's valid for 5 years, a lot easier to get funding. Part of the conversation we've had with clients is that you're not committing to building, but you're just committing to getting ready to build. The way I see it paying out is they're just going to be in such a powerful position when we do see some of these changes that a lot of people are perhaps expecting coming to fruition. They're going to be ready to go at the front of the queue. Banks will be wanting to deal with them, and they can commit and move really quickly when they feel the market is right for them.
I think it's so important what you touched on earlier as well, is looking at the calculations with the client. There are so many mum and dad investors with a bit of land. They want to okay, I am going to build on this. I'm going to do a development. A lot of them don't have a super numbers driven sort of decision making process. They might look at how much they acquired the land for, and therefore if they built at a certain price, that's the margin they make. But what you really want to look at is today's value. If you sold the land, how much is that worth? And whether or not, if you just sold the land versus if you built, right, the profit might be similar, right? So a lot of people want to go through that break-even exercise. They got all of this emotion that was in property that they, held for a while. They want to do it. But yeah, a quick calculation, it just doesn't work. So it's so important to do the numbers early. And I guess now that it's harder to do finance, it costs more, people are being more aware, okay, I need to get outside advice before I even start the project. Because even though you can build whatever you want to build on it, it's should you?
Yeah, you couldn't hit the nail more on the head there. There's that issue and the issue, where we find some people are in a position where by the time you account for the build and then the actual subdivision of land to create all the new titles so you can flick it on or whatever you want to do, sometimes there's an argument that they could go and buy similar properties with a full section for the amount that they're spending to develop. Not every development stacks up, and especially right now where there's high interest rates and slightly lower end values, not everything does stack up. But a lot of it depends on your intention for doing it as well. If you extrapolate anything out at over 30 years, it'll probably start stacking up eventually, right? So it depends on people's intentions a lot. We do deal with mums and dads who want that 30-year nest egg, in their front yard. They'll pass it on to the kids or whatever it is. They're setting up equity and security as opposed to trying to make money quickly, I guess.
No, that's really good. I wanted to ask you as well, because obviously Ashcroft's business model, we talked about that in the last podcast. Now, because the market fluctuates a lot, prices goes up and down, land value goes up and down, you got the sale price as well going up and down. How can your model create certainty for the client? How do you try and strive for that? You certainly, there's always going to be some variables, but what is it that you try and do to give that certainty?
It's really hard to create that certainty early on, but it's part of the role as a property development consultant. So, before you spend any money with Ashcroft, I should be able to give you a pretty clear indication of what I think we can build on your property. I can let you know what it costs to build that house today if you were to sign a build contract with us. And I can sort of give you indications on the subdivision and site works for said project. So very early on, we try and be very transparent with clients. Like, we don't want to start spending their money if it's fairly obvious that we can't fit what we're proposing, or that perhaps they can't finance it, or that perhaps it's just going to cost a lot more than they thought. We're very upfront and transparent about that. So I'd rather you walk away knowing that you shouldn't be doing this or you can't be doing this, as opposed to, taking some money, drawing some concept, and knowing that we're sort of not going to go anywhere from there.
You know how I would put it? I would put it as Ashcroft. They're very picky on their piece of land.
Yes.
So if they want to build for you, your piece of land is probably pretty solid, and they want to be like, yep, we'll do it because we know we can. And I think that's definitely one thing that you guys do well. It's like, okay, well, you guys got so much to choose from. You guys don't need to, try and push every deal through.
That's right. And because we are a standard plan company, like I'm a qualified builder, so I'll be the first to tell you when I think you should go design and build, because sometimes the slope of the section, the shape of the section, it's just really hard to maximize with standard plans. Or I know that you'll be spending a lot of money creating the level building platforms for standard plans. So yeah, very important, that sort of upfront feasibility and making sure we're also the right builder, for the client. So yeah, we do all of that sort of as part of our free feasibility assessments. And then from there, we have a package called the Develop Concept Package, where we'll actually go draw the plans. We have engineers look at it. We have planners look at it all. And then we go ahead and actually provide full build costs for the entire project, basically. Right there, clients will have sort of a circa cost of the build, subdivision and site works, which should allow them to start really working on their numbers and seeing if the project stacks up and they want to proceed to resource consent. So that Develop Concept Pack is really, really important. It's not very expensive to do, because we're not actually designing the houses. We're just seeing how they work on your property. Really,
because they're already pre-designed. You guys have template builds. You're like, okay, this is a 3-bedroom duplex. This is a 2-bedroom terrace. You guys already have those. You plug it on the site and be like, yep, you're playing jigsaw puzzle, or more almost like Lego. See how many you can stack onto the site.
Yeah, arguably. And from there, then telling you arguably how much all the pipes and the paths and all that stuff people don't really think about. So, we often get people who might ring our website, or ring us and say, we looked at your website and I see there's a house here for $430,000. And they sort of think that that's going to be the cost to build the house and do everything else. So that's just the cost to build the house. There's all this other stuff to consider as well. So Ashcroft's really good at painting that picture. We definitely don't sort of leave anything out.
Because obviously, like the standard plans though, because while we're on the topic, if you have standard plans and the market changes, how do you keep up with that? Like, what's your process in choosing what plan's relevant?
Yeah, for sure. Often it's not as much on the actual plan or the layout or that sort of stuff. It's more around the planning rules on the site and working out how I can maximize the available space, I guess. So there's basically 2 big differences. You get your houses that don't have internal parking and then your houses that do. And often, if I'm looking at a building in the back or something like that, typically there'll be houses with garages, a duplex, and then basically I'll take the available space I've got and match up houses to take up that available space. So very efficient in a sense. And so my role isn't so much, unless I've got somebody who's building a family home or has some pretty specific requirements. Often it's just maximizing the available space with whatever type of dwelling that the client's looking to do, whether that's a terrace or a house.
I see. So your goal is more about maximizing the space and just giving them best bang for their buck.
Basically, often that's what it comes down to, is sort of knowing how close you can get for your height in relation to boundary, your setbacks, all of your planning rules, and then say, okay, this is the space I've got to work with. What are basically the 2 or 3 or 4 biggest houses I can get to fit in this space in whatever configuration? And often we don't just have one option. Common scenario might be you can do 4 standalone houses, or you can do 6 terraces with parking. So sometimes we'll have 2 options that are very close in build costs, but perhaps could see different end values. And that's where we'll provide those options for you to assess and go talk to people like agents to get a better understanding of perhaps end values. And I think that's worth touching on. So I think there's sort of 4 really important people when you're developing property. Number 1 is somebody like myself, so the construction guy, construction expert. Number 2, broker, yourself. It's understanding the finance, and those 2 in conjunction, because if you can't afford to do something, it doesn't mean you can't afford to do anything. You might come see me and I show you 6 terrace houses at $3 million or $2 million, whatever it is. You come see Blandon and he goes, you should build in the back. So So there's sort of a relationship between the money and what I do. Then a good lawyer, because obviously there's different commitments you're making in terms of contracts and agreements. And then obviously when you go to sell the properties as well, you need somebody to do all the titles. So those three people, and then a good agent, which is probably not the most important thing, but very important. You need an agent who can see the value. Often what we found in a really hot market is that agents aren't as keen on development if you're not working with the right agent. So like they'll try and convince clients to sell without exploring development options, or perhaps give negative feedback on development options because they're not keen for the long game.
Yeah, because it's like if they don't have a pipeline of listings, it's like why would they want another 12 lots that they don't get paid for another 24 months?
Well, you couldn't have said it more straight up, right? So it's finding someone you trust, right, and who can see the value in developing and who can give you that sound advice, so that when it does come into a hitting market or rent or whatever, you're going to use them. They'll get their kickback then, and everyone's happy families. And sort of the sad thing is actually that the agents will make far more commission if they just waited for the development to happen. They'll make sales on $5 to $8 million worth of property instead of $1.5 million. It's just finding that person who can see the value and is happy to help play the long game.
No, that's really good. As my last question for the day, what kind of developments are your clients working on at the moment? Tell us some of the trade secrets.
Yeah, for sure. I've had a really interesting sort of 12 to 24 months with a lot of my clients. I think I touched on it before, but probably like 80 to 90% of my clients have been building to rent. And I've got people who are building everything from sort of one or two in the back of their existing property that they live at, long-term rentals. Some have struggled with finance, but a lot of them have made that commitment and see the long-term value. I've had a few clients who've taken on sort of larger projects, but surprisingly all build to rent as well. And by larger, we're now talking, sort of 8 two-bedroom houses. I've got a client who's replacing a sausage block. So there's 4 houses there currently, really bad state of disrepair. So he's looking at 4 of our Windsor design and 4 of our Newcastle design on there. So really neat, tidy development. I've got some clients who are just up the road from him and actually approached me wanting to build an apartment block initially. It was a really interesting journey from a sense that I presented what I thought Ashcroft could do. They went away for about 6 months and explored building the apartment block. I believe they were dealing with an architect, and they got a considerable way down that path. And they obviously realized it was just going to be a bit challenging. I mean, it was going to be a very big ask to build an apartment block. Yeah,
do you even build apartments?
No, we don't. We don't. So
is there no conflict of interest there?
No, definitely not. And I mean, and they genuinely explored it. But yeah, come back and decided to commit to 8 houses on their property. And through the design process, I think it was either a metre more of length or a metre more of, I think it was width, to do a central driveway and get 8 of these houses on. Property was just too narrow by the time we put in all the retaining walls and sort of did everything. Yeah, I had to work closely with them on my feet to come up with a different design that still sort of got 8 houses on the property. It coincided well with the release of our Daventry design, which is one of our first 3-story designs. Yeah, and their zoning was right for 3 stories. So we ended up building 4 Daventrys and 4 Newcastles on the site with 8 car parks.
Tell us the pricing on some of those ones, like just roughly.
So
like a 3-story, how many square meter, how many bedrooms?
Yeah, I mean, and you test to me. Something like our Daventry design, I believe it's around the 550K mark, but I'd have to double check. We do have different pricing for, say, a middle unit and then a front or an end unit. Daventry's 180 squares. It's got a 20 square meter covered deck.
180 square meters.
Yeah, might even be 186, but I think it's 180, 20 square meters. As standard, it's 4 bedrooms with an office. And yeah, living on the middle story, nice covered deck. Can make it 5 bedrooms if you turn the office into a 5th bedroom. And it's also got the single internal garage parking.
Guys, just did some quick maths. We're looking at like 3,000 square meter per square meter.
I'd have to double check the build pricing, but I believe it's somewhere in the region of 550.
Yeah, so it sounds like even if it's at 3,000 plus GST, I think the plan is still quite strong price for something like that. So definitely worth checking out.
Yeah.
It's similar to...
if anyone wants to...
Yeah, it's not the Newton, it's what's the name again?
It's the Daventry.
No, that's really good. So I want to know though, what are the veterans doing? The veterans,
I'd say, so a lot of these guys are probably sitting on their hands for the last 12 months in a sense that they're the type of guys who are probably getting build ready, so they're getting their consents ready and looking at simpler projects. So some of our most prolific clients keep things simple. They're just continuing to do what they've always done, but we've definitely seen a shift in build to rent. Probably couldn't emphasize, or especially for my clients in the sort of challenging market we've had. So even some of those hardcore guys are changing the way they're doing projects.
If they're sitting on their hands, I'm assuming they're probably just looking to pounce when there's a good deal.
Absolutely. I mean, we've seen some of the best opportunities for buying development land in Auckland that we've had in the last 6 or 7 years probably. There are people taking hits on properties out there. I think 2-3 years ago, there was a lot of people who weren't developers who wanted to be developers, who perhaps were buying additional properties with the intention of developing at 2.5% interest or whatever we were at, right? And I think that equation has changed for a lot of people now. They're now looking at refixing at 7%. And they're going, actually, perhaps not such a good idea to own this investment property. But the problem they're finding is that they're now going to sell and they can't sell for what they bought it for. So they're kind of screwed over. What's a better word? They're struggling to find a way forwards, and sometimes those are the guys taking the hits.
It's definitely hard if people don't try to go on that path of educating themselves first, understanding. I mean, property, like most of the time you can get 80-20, but when you're playing with land banks, like the margin shifts really, really quickly because, it's based on really big numbers. So that definitely, I know what you're talking about there.
And like a lot of these guys bought the properties with very little regard for the existing house because they always thought, I'm going to knock it down. So sometimes, they've gone backwards, so they're looking for that out, and we're seeing properties that may have been, especially out south. Like we saw some huge sale prices for some property out south, and now some of that has dropped by 20 or 30 or sometimes 40% compared to some of those real big numbers we saw. So great time for people to be acquiring more stock, especially developable stock.
Next time I know how to play the game when we're in that situation again. Sell everything.
And I mean, and that's development, right? Everyone wishes they had a next time so that they couldn't make, some of those mistakes. It is really tricky. There's hundreds, if not sometimes thousands of things to think about. But that's why it's important to partner with a company like Ashcroft, because we think about a lot of those things for you. We'll make you aware of a lot of those things and, help set your expectations for the journey that is development. It is high risk, but at the same time, it's high reward. But you'll never know if you don't commit to that first one, and you'll probably learn more in that first development process than the next 5 after that.
That's really awesome, Mark. Thank you so much today. And there you have it, folks. We got a deep dive into property development landscape, some of the election changes that are coming and what Ashcroft can bring to the table if you guys are thinking to do that next development or buy that land bank and just understand that whole process a bit more. Mark can be your guy because he doesn't charge you for your first consultation. Massive thank you again for your insights. For our listeners out there, if you guys have found value, all I ask for is one simple thing, and that is to share this episode with one person who you think can find value from it. And until next time, I'll see you guys again. Thanks, Mark.
Thank you very much for having me.